Yes, to get some perspective on this market, we have Kashyap Javeri, fund manager and head of research at MK Investment Managers, joining in with some thoughts. Kashyap, hi, morning. Good to have you with us here on Moneycontrol. Thanks for taking out the time. So,
morning. Thank you so
Kashyap. So, Kashyap, let's start with earnings, right? Because this last 1 month has been all about granular numbers and individual stocks. And on that count, I think, and most people I've spoken to agree, that this season has been better than what we expected. What's your assessment?
So I think what we have seen is, couple of things. One, what we have seen is even more enduring democratization of earnings. So if you look at sector-wise, small cap have done better than mid cap, and mid cap have done better than large cap across the sectors. So earnings are getting more and more democratized. That's one point I want to highlight. The second is that after a very long time, what we have seen, and this is our conversation with across the brokers that sort of service us, that if you look at upgrade to downgrade ratio, has seen significant improvement, and which is quite contrary to what we were expecting at the beginning of this earnings cycle. So I think these two things clearly stand out, and I think from market standpoint, these are much rejoiceable facts that have come out. If you look at sector wise, I think what has done phenomenally well is NBFCs. Chemicals has done really well. If I look at broadly healthcare, and within healthcare, CDMO has particularly done really well. Auto OEM, and in some FMCG stocks, we have done a significant spark happening. So overall, I think there is much to take home, nothing to complain about in this earnings season.
Kashyap, I completely get that. I agree. But then the next question, the market has also rallied, right? We are at now index level 24,600. Individual stocks have also been rewarded where numbers are good. So, ab aage kya? Is all the good news already in the price?
I completely agree on that point, that aage kya, right? And if I look at even at 24,600 today, what's lined up for the market, broadly people are expecting anywhere between 1100 to 1150 to maybe 1180 odd rupees of EPS for Nifty for FY27. That discounts today's 24,600 of market at about 22 and a half kind of multiple. That leaves us with about 4.5% earnings yield. I think that's nothing to complain about. I think it's fairly reasonable at this point of time. I think what we also need to look at is what's lined up over next 12 months for the market, right? If you look at earnings, I think they are going to see upgrade, over next about 12 months versus what we have seen in terms of fears which have, been in the market for quite some time. I think we will see some upgrades happening there. Point number two, for market to move, you need liquidity also, right? If you look at FPI flows in the month of July, out of 23 trading days, we saw about 13-14 days when FPI flows were actually positive. For August, all 3 days have been positive. We have seen FDI flows which have been very robust for the first 2 months. If you look at domestic flows, they have been about $9.5 billion in terms of equity or growth-oriented funds. If you look at broader liquidity, we are already at about $50 billion of excess durable liquidity in the market, even prior to this whole FCNRB scheme happened. And we have received another about 30-40 billion out there. So I think liquidity is not going to be an issue. In that sense, if earnings and liquidity both are there in the market, I would say that, in terms of market movement, probably at this point of time, what we need to be really aware about is probably what could actually go wrong rather than, are there any positives in the market?
So, but from what you say, Kashyap, I mean, my question was pretty simple. Saying, are we heading higher or is it all in the price? We'll talk about the risks in just a bit, but first address that.
Yes.
Yeah.
So I think, like I said, at 22.5 12-month forward earnings or trailing earnings, I don't see valuations being unreasonable. If I look at earnings growth in terms of small cap has been higher than mid cap versus large cap. So I think small cap are being rewarded for the earnings resilience or democratization of earnings, like I said, and they are being rewarded about it. I would say, I probably at this point of time, and it's been our view all this while that, time to in the market is probably better than timing the market. So we would remain invested even at this point of time.
Then now let's come to the other part. You said we should talk more about what can go wrong rather than what can go right. So from the top of my head, one thing I can always tell you, oil, right? Right now, again, where there's a deal,
Absolutely.
Apparently they're opening up the strait. But I think the market also knows, markets have learned their lesson. They know that take everything with a pinch of salt and not get carried away. So I suppose we're not expecting oil to decisively go back and stay below $70 a barrel in a hurry, right? So that's one risk, but it's a known risk. What else?
So I think more than oil, one needs to also keep a tab on what the gas prices are doing. And if you look at European gas prices, they are still significantly, above where they were prior to this whole, thaw which happened in terms of the war. They still continue to remain quite high. And I think higher gas prices would be detrimental to some of the feedstock prices also. So I think that's one risk which continues to lie out there in the market. The second is, when there is a significant demand happening in terms of newer and newer applications for raw materials, I think we have seen that, inflation on that side has also not cooled down as much as what it was pre-war, right? It has come down, but not as much as pre-war. So that could be, a second risk out there. And last but not the least, though rainfall has now improved significantly, but overall, if you look at sowing, that's still roughly about 2.5% below what we had for the same period last year. And we have seen that food inflation within the overall inflation has also been, quite, let's say, sort of thorn in the whole bouquet. So I think, there are some of the risks that I would keep looking out for. But like I said, at this point of time, to me, overall market looks quite comforting.
So Kashyap, then finally, since you're constructive and you're fairly positive on the market from here, if you're going to deploy fresh money, now we've discussed some sectors in the past which you've liked, but today if you're going to put fresh money to work, where will it go?
So we continue to deploy our money in the sectors that we like a lot. So we have deployed some bit of money in automobile. I would not sort of divulge whether it's ancillary or OEM because that would sort of spell out everything. But auto and auto ancillary is something that we continue to deploy our money in. We continue to like healthcare, but within healthcare, we continue to like CDMO. Recently, we have raised some of our exposures in even more in the discretionary spend. And within discretionary spend, it would include everything right from auto ank to consumer durable to small appliances, right across the spectrum. I think overall discretionary spends within the economy post the GST cut or if you look at broadly the rural income outcomes, I think that's something that is going to continue to do reasonably well. And I think that's where we have deployed more of our money if you look at last about, let's say anywhere between 2 to 4 months.
So you're saying as a broad theme, consumer discretionary is where
Yes.
you're quite constructive right now. So let me try and drill that down a little more. Auto, fine, and auto, you've been positive on that for a while now. How else are you playing the discretionary cycle, the consumption cycle?
So some bit of money we have deployed in, I would say anywhere between, FMCG to small appliances to consumer durable. This is the whole spectrum within which we have deployed more of our money. I think that pretty much, including auto, covers the whole discretionary spend part of it. I think the only place where we we have not yet done probably any, and actually, we have done also on the housing side, right? But not through realty, but through housing finance part. So I think the whole gamut of discretionary, including large ticket spends, which could include even housing for that matter.
Got that. Housing finance is one play of more disposable incomes for sure. Just to pivot the conversation now towards industrials, Kashyap. This quarter has told us one thing. I mean, all of these high-flying capital goods stocks, power equipment makers, very glamorous stocks, and some of them obviously commanding hefty valuations as well.
Yes.
Now, earnings have shown some hiccups. There are margin pressures in a lot of the companies that we've seen, including some of the names like GE, Vernova, Cummins. Most of them reported. Thermax had a bit of a difficult quarter as well. But again, the argument is that these are industrial companies, don't expect a straight line trajectory. So you've got to be patient through the rough patches. Or do you think the earnings now are an indication that we may be close to the end of the party, or, towards the peak here? What's your sense?
So I think in terms of industrials, our belief is that if the consumer discretionary spends are going to continue to strengthen or remain strong from here on, you would need to do capex as you go down the line. Even if you look at some of the recent surveys which have been announced by RBI, forward-looking surveys, the overall capacity utilization within the industry continues to remain 75% plus, even on seasonally adjusted basis, and that's where I think one would start thinking about putting up more capacities. So I think overall the view that you also highlighted, which is that these are the companies which have usually they never have a straight linear earnings trajectory. What one should continue to look at is the order flows and outstanding order book. Even for the companies that we have under our portfolio, what we have seen is that the order flow has remained strong. Order backlog has remained very strong. Because of certain reasons, there was execution challenges which happened in this quarter. They can be geopolitical, they can be climatic, either ways. So we have seen erratic execution of the order book, but overall flows plus the backlog have remained extremely strong. And I think we continue to remain quite bullish out there that as we produce more and more of what we consume here in India, or in fact, if we are to become a factory to the world, capex is something that cannot be shied away from, and that will continue to happen. There will be obviously quarters where the earnings will not grow, but the order book and backlog will grow, and that's something that we should continue to look out at. So it remains on our radar even at this point of time.
Fair enough. So you're still very much a believer and staying the course.
Absolutely.
Finally, Kashyap, I mean, what's the overall advice? Again, just to recap, Kashyap is fairly optimistic on the market, looking at the earnings, looking at the valuations right now. We've discussed some of the sectors that you like. Any immediate risks on the horizon, or anywhere where you think some profit taking is warranted?
So I probably, in terms of profit taking, I'm not too sure at this point of time. It depends individual stock and on their valuations. I don't think there is any sectoral view out here that we should this is the sector which looks overheated or sort of not so great. But like I said, stock wise, we have been booking profits, and that's something which will continue to do based on the value versus the pricing. I think that's what we will continue to do. Like I said, our advice to our clients has always been that time in the market is better than timing the market. There is no way one could have predicted probably in the month of March that this whole risk of war will get resolved in April, May, June, July, August. We still don't know, right? And it's something that we cannot even know at any point of time, besides only one guy in the world. So I would say that leave that part to the professionals to decide how much to deploy, when to deploy. But your timing in the market is not as important as your time in the market, and that's what we would continue to advise.
All right, that's great advice to end on. Thank you, Kashyap, for joining in. Good conversation as always, and wish you a good day.
Thank you so much.
Talk again soon. Thank you.
Thank you.
All right, there you have it. A view coming in from MK Investment Managers. Still quite positive on the market, and talking about the earnings, which have largely been actually better than estimates.